The markets are imploding utterly and catastrophically. I didn't think it was a particularly interesting subject, but so many people have spammed me on Twitter and in the comments that I should cover it. So I thought, okay, fair enough, let's cover it. This tweet covers it fairly well. We got this chap saying, look, over 3.8 trillion has been wiped from the stock market and crypto markets within the last week. This crash is now ranked as the largest destruction of wealth in history. And just to prove it, he's got a picture with lots of red on it, which is obviously scary. So yes, very bad indeed. In fact, I've also got a quick segment from Fox News that sort of sets up the situation. Samson, can we play that?
Some would call history in the making. Scary. Don't say that.
We have never been down 1,000 points ever, not even intraday on the NASDAQ.
Is that true?
That is true.
Okay. Down 6% right from the get-go. This is heavy big tech. Here we go. Look at them go down. Microsoft is down $20. That's 5%. Alphabet, 5%. Meta, 6%. Amazon, 6%. Apple, 9% down. Let's pull out Apple. This is interesting. A question for you.
No, should we leave it there?
So, what does this mean? Obviously, people who've got money invested in the market, that's terrible for them, right? Obviously, there are losses there. But what does that mean for people like me who, to paraphrase the World Economic Forum, own nothing and are unhappy?
Oh, it's all bad.
Oh, good.
Yes. It's bad over a longer time. It's just that the people with assets are having a very temporary bit of also badness, just so they can be reminded of what it's like for the little folk every now and again.
Okay.
So, yes. So it's not good, unfortunately. I've got to say, as an investor myself, I'm entirely relaxed about it. I mean, I didn't really even flinch at this news. I'm entirely relaxed. Nothing has changed on my big view of what's going on at the moment. In fact, I did a Broconomics a few episodes back. Oh, I don't know where that's come from. I did a Broconomics a few episodes back on how it's about to change. I was talking about the liquidity that's coming in the markets over the course of the rest of this year and next year. And I laid out a fairly bullish case in that. That's quite a popular episode. That lots of people have watched that. So, check it out if you'd like to understand my thinking behind this. But, begs the question, did I get it wrong? Did I perhaps, pitch it incorrectly? I don't think so, because ultimately this is just a question of timescales. So I like to make money over the full business cycle, which is about 4 to 5 year period. I've never been into the short-term trading stuff. If you are into the short-term trading stuff, there's not really a lot that I can say to you because I don't really understand that market. Every time I've attempted to do short-term trading, it has ended disastrously. So I just
don't do it. A very risky thing to do. It's the most risky, but you stand to gain a lot.
It takes a hell of a lot of time and attention. So you can be an investor and spend most of your time on the golf course. If you want to be a trader, you need to be looking at your screens at a couple of hours before the market's open, and you need to be there every single day. You need to be thinking about it all the time, and I just haven't got the energy.
So it's basically the equivalent of Twitter strategies. Some people are constantly online.
Well, some people have a different temperament for this.
They just have 2-3 good tweets.
Yeah, if you've got the temperament for it, you find it difficult to do the other one.
Yeah,
whatever your temperament and disposition is. So I'm just going to zoom out. And I'm going to ask, what is the root of this? The root of all of this, the financial system that we have and the economic issues that we have, is all a downstream product of the government spending too much money. They just can't help themselves. Right now, that in turn is driven by demographics, but I'm not going to get into that here because I've got Broconomics that you can go and watch if you want to get into that level of detail. But the underlying issue is governments are racking up enormous amounts of debt. And they can't afford to pay that debt. So the whole game now is, how can we debase the currency over time? Because that will make the real value of the debt decline. Obviously, being £100 in debt today is not a big problem. Being £100 in debt in 1900 was a big problem. But of course, the value of the money itself declines, and so you want to try and get rid of your debt by debasing the currency. That's what it's all about. And all of that still holds. So what happened in this particular blow-up that everybody is so animated by? Well, it's a number of factors. Some people say it's the jobs report that came out. Some people who say it was the Japanese. Ultimately, what it's really about is that the economic regime is changing from one of financial tightening to financial loosening. And all of these are factors within it. But what we're going to see is interest rates coming down. We're going to see the quantitative tightening stopped, and we're going to see the business cycle turning up. Don't worry if you didn't understand what I just said. That's what Brokenomics is for. But let's just pick up on one thing that people have been talking about a lot, which is the whole Japanese angle. So I'm going to quickly whiz through that just to sort of detangle it a little bit. When I said governments spend a lot of money, very, very true of the Japanese. They run up lots and lots of debt for whatever. Well, they got an aging population.
Well, they're pretty renowned for a lot of deficit spending, aren't they?
Yes. Well, and they've got a very aged population. So the whole demographic point that I made is, their demographic cycle is like ours, but 15 years earlier.
Mm-hmm.
So, yeah.
They are also one of the cases, isn't it? Japan and Argentina that are sort of held up as countries that always seem to defy most economic rules. So,
well, actually, the Japanese tend to lead on a lot of this stuff. So they were the first to do quantitative easing.
Mm-hmm.
They kind of invented it. And they've now kind of moved past it to do something else. So let me briefly explain quantitative easing. I think most of you guys know what it is. Basically, it's money printing. But the way they do it is they say, okay, there's lots of our government debt circulating. So what we do is we buy some of it back. So we will swap cash for debt. So basically, you're putting cash into the system. So it's like money printing, but it's not exactly, but it's functionally the same thing. It has the same result. So that's why we just end up calling it money printing, because we might as well. But there's two different kinds of money printing. There's the quantitative easing, which you do what I said just now. But the way you do it is you buy a fixed amount at any price. So you say, I'm going to inject whatever it is, 500 billion into the economy. And I will buy 500 billion worth of that debt that's out there and swap it for cash. But I don't really care what price I pay. The Japanese do the sock inside out version of that, which is I'm going to buy an unlimited amount of debt, but at a fixed price. So effectively what it does is it puts a cap on the price of Japanese debt. So it's a very effective way to keep their cost of money very low. But there's a problem with what they do, which is called yield curve control as opposed to quantitative easing. It's a trap. And once you get into it, it's incredibly difficult to get out of it. And they've been doing this for a long time. Now, they can get away with it because they've got huge foreign reserves of stocks and assets and debt and a whole bunch of things from other countries. But they had their currency level down at such a low level that what people were doing was something called the Japanese carry trade. Now, that sounds like it might be complicated. It's not really. It's as simple as this. You're a macro investor. You want to invest somewhere in the world, basically America, because they have the highest returns. Where are you going to get the money to invest in America? Well, you're going to go to wherever you can get it the cheapest, which is Japan. So you borrow money in Japan, so you got the yen, you immediately sell them and buy the dollar, and then buy investments. So what does that do? Well, you've got this constant push of people selling yen, buying dollars, so the yen goes down and the dollar goes up. So you end up with a strong dollar. Now, governments generally don't mind having a weak currency because it helps them in sort of ways. But you don't want it too weak, because if it gets too weak, well, that causes a whole new set of problems. So this yield curve control trap that they got into, they needed to alleviate it just a little bit. So what they did is they raised their rates by 0.25%. It's not much, right? But financial markets being what they are, is they always exploit every opportunity to the maximum extent.
If you have a very weak currency, essentially foreigners can buy a lot of your assets very easily.
Yeah, and it also gives you problems, buying stuff that you need to buy from the rest of the world. So
Yes.
So Japan has a big trade surplus, so it's not that bad for them, but they still need to buy oil. They still need to buy raw commodities because they don't have much. There's still a whole bunch of stuff that they need to buy from the rest of the world, so you can't let it get too low. So they raised that interest rate by a tiny smidgen. And because so many people in the financial markets had been borrowing money from there and investing it there and taking it right up to the limit, even a small movement means that a whole bunch of trades are now offside, that you need to unwind them to rebalance it. So that led to a situation where a lot of financial participants had to sell stuff in dollars, mainly, so that they could then send the money back to Japan to pay off their debts. And even though it was a tiny incremental change, because people leverage up and they do all sorts of silly things, it creates absolute turmoil in the currency markets, and assets and stuff has to sell down. And it's kind of like a python swallowing a deer. You know, the python's still going to be okay, but he's just not going anywhere for a while. He just needs to sit it out and digest it, and that's kind of what's happening in markets.
From what you've explained here so far, it seems to suggest that this will correct eventually on its own.
Yeah.
And it's just a potentially temporary thing, although there might be some more long-term effects as well.
Yeah, that's the key thing that I'm saying. Nothing fundamental, in my view, has changed. You know, the governments are still drowning in debt, and they still can't afford to pay it, and they still have to debase the currency, and they still have to ease financial conditions. None of that has changed. All that's changed is that there has been a disruption in the flows, and it's upset the equilibrium, and everything's having to readjust.
This seems entirely unsustainable. And what is the rationale for them doing this, or the excuse? Let me say.
So,
or are they saying that we're going to collectively bargain for debt cancellation? Because that doesn't seem.
So, if what you're asking is the bit about the government's overspending, is that unsustainable? Yes, entirely.
Yeah.
And the whole plan is to put it on the next guy. So you get elected, and you do all the bad things, and then you let the next guy worry about it, and then the next guy has a bigger problem, and we're now at least 50 years into it being the next guy.
Yeah, I mean, you're describing my country of origin.
Yes. Well, I'm describing all of them,
Yes,
really.
yeah.
I mean, all of them. I mean, apart from
That
Russia.
sounds familiar.
Yeah.
It reminds me of something.
Yeah. So, you know, nothing fundamental has changed. My timescale is 4 to 5 years. My current investment cycle began in 2020. So I tend to operate in these cycles, and the current cycle began in 2020. What happened in 2020? Well, in 2020 and 2021, governments borrowed an obscene amount of money for their whole COVID shenanigans, right? The US, for example, borrowed 10 trillion over that period, and most of that now becomes due end of this year, next year. So they need to refinance it.
Question, I think,
Yes.
for our audience. When you hear something like that the US nation borrowed $10 trillion
Yes.
during the COVID thing, from where?
Oh, well, they issued debt which was bought some by financial institutions in the US because they're obliged to do so for capital adequacy rules. Some of it to foreigners, although foreigners are buying less unless they want to buy gold instead. Some individuals, some other governments. I mean, different spread of different people.
Okay.
But they put out that debt, and they're going to have to refinance most of it end of this year, next year, right? And here's a simple point: they do not want to refinance that debt at 5.5%, which is the current interest rate. So think about this: if you, well, let's say you got a mortgage, and you've done a 5-year fixed, and you want to roll over your mortgage, but by happy coincidence, you've been handed the power to set interest rates, right? What are you going to set interest rates like a week before you need to roll over your mortgage? Yeah, you're going to set it as low as you possibly can. Then you're going to roll over your mortgage, and then you can let it taper back up again. And thus that cycle that you get into, that the governments have got into. And it started, well, I suppose you could argue that it started in like 1998 with the Asian financial crisis, but it was certainly in full stream with the dot-com and the 2008. You tend to get these 4 or 5 year cycles that carries on. So they don't want to refinance at 5.5%. I think they want to push it down to something in the range of 2 to 2.5%. Right, and it's either that or they massively cut spending. Now, the only things that the US can cut of a scale that actually makes a difference is going to be the military, Medicare or Medicaid. Right? And the Americans in the chat can tell us how viable it is, how politically viable it is to slash those 3 areas of spending. You know, I would argue probably not particularly high.
Don't do the military. That would be my advice. Not at the minute.
Yeah, well, I mean, maybe they should. Certainly the CIA bit, anyway.
Well, yeah,
but yeah,
that's better for everyone there.
So they want loose monetary conditions. They want lower rates. They want printing. They want debasement, and that drives up market. So the 3 reasons that I am not panicking even a little bit. Right, 1, lots of debt to roll over, and they want financial conditions lighter for doing so. The business cycle has turned, Again, I won't explain that here. Go watch Brokenomics if you want to get the full rundown of that. But essentially, inflation's a lot lower. Unemployment is going up. So one of the things that you don't want to be doing is lowering rates when unemployment is high. But basically, the Federal Reserve Governor, they set out their criteria for what they want to lower rates, and all of the signals lights are turned green for them. So all of that is set. And the third reason why I'm bullish is because there is an election coming up. Another big pool of liquidity is something called the TGA, the Treasury General Account. That's basically Janet Yellen's current account, and it's stocked, is brimmed at the moment because the US had their tax season and she just kept hold of it. Now, the reason she's keeping hold of that might be because she likes doing the whole Scrooge McDuck thing of just diving into the big vault of money and swimming around.
Does sound like her.
Or it could be, a little bit skeptical here, it could be that she wants to help not Joe Biden, it's the other one.
Kamala Harris.
Kamala Harris, yes, the new one, if she sticks around by the time this comes out at 8 o'clock. She wants to help the Democrats, of course. So that money is going to come pouring into the US economy sometime between now and when the election is. There's going to be, and this always happens. You can look at election years in the US are always quite good for the markets towards the end of the year because they always pull this trick, right? And then I'll give you a bonus reason as well, because some people might say, okay, what about the crisis in the Middle East? Well, I mean, there's always a crisis in the Middle East. I mean, ever since I began investing, I'd had people saying, "Oh, what do you think about the crisis in the Middle East?" It's like, "Oh, what, this one?"
People factor that into their market calculations, don't they?
It's just it is permanently in crisis, right? And let's take worst case scenario. Let's say full regional meltdown, US war against Iran, and all the rest of it. Right? Well, what does that mean? Well, do you think that spending's going to go up? Yes. Right. So and where they're going to and if they're going to spend more, do they want cheaper money or do they want more expensive money? Well, they want cheaper money. So that is more liquidity pumped into the whole system as well. Now, at some point, these factors will change, and I will turn from being net bullish as I am now to wanting to sell or at least reduce my positions down. That is not now. I doubt it will be this year. The big question is when in 2025 I think that's going to be. It's definitely not going to be before the election. But at some point after that, I will flip to my views will change. If you want to know more, again, follow Brokenomics because I won't be going through it here. But at this point in the business cycle, what we're going through is basically just normal. These are financial markets responding normally to an abnormal and broken government set of policies, which are broken. So if you're an investor, I would say don't worry about it. If you're not an investor, if you're a wage earner, to come back to your original question, then this whole situation is utterly obscene.
Yes,
utterly obscene.
Mm-hmm.
Because basically for people who are investors, you just don't need to do that much apart from just know a bit of stuff, and you can just make lots and lots of money, like from one cycle to the next. And it's all in service of the underlying government motivation to drain the value of money, to make money worth less, which means that your wages are worth less. But because different prices respond at different speeds, so house prices go up faster than wages go up. And they always do that. And the gap between the two is always getting wider. So for wage earners, yes, for wage earners, this is just awfully bad. So I get how obscene it is, right? And I don't agree with it. And the whole reason that I do Brokenomics is to highlight how badly screwed wage earners are and how unfair it is for asset holders. And, what you can do about it. That's what Brokenomics is all about. And yes, I make money from it myself because, you'd be foolish not to. If you can. You just would. But that doesn't mean that I agree with it. I don't agree with this system. But this is the system that we have. And I'm not in a position to magic it away. The only thing I can do is, come into Lotus Eaters and make videos that explain it and run a Brokenomic series that explains it. So, if anyone was about thinking of raging at me in the comments, I get that it's bad. But it's just nothing I can do about it apart from explain it. But if you're an investor, happy days, all that. What I will end on is, this. So this is the sort of the whole net effect that I'm talking about zoomed out. You will notice that this is a line that goes up and to the right, but it's not a straight line. There's lots and lots of jagged sort of downward motions in that chart. And this chart goes up to, it's already ended. So this would have been a few months ago, I think. But basically at any point when it was hurtling downwards, it would look very scary. And you'd be, lots of articles about, the world is ending and all that kind of stuff. But then it just goes up again because governments spend too much. They create too much debt. They have to devalue the currency. So therefore, everything gets repriced. And so the whole game becomes, as an investor, well, if everything's getting repriced, how do I put myself into something which is going to come out comparatively ahead of stuff that is going to come out comparatively behind? And so, my takeaway message on this is, unless you're a short-term trader, in which case, woe you, well, unless you were short at the time, because, you probably just lost your house if you were long. Unless you're a short-term trader, don't worry about it. You do you, but personally, I will buy the dip. And if you're a wage earner, just note that this is woeful, and the chances of getting a house will become even more difficult. Sorry about that.
I hope you appreciated that segment from the podcast of the Lotus Eaters. And if you want to see what else we're up to, we recently put out a video, the England riots, where we talked about the situation, believe it or not, in England. And if you want to see what else we're doing, all the other work, you don't want to miss anything, you can follow us on Twitter. We post links to everything we're putting out. Thank you very much for watching, and goodbye.